Hi, my name is Sherwood Robbins. I'm the Managing Director at Seedcopa. We're a certified development company here in Pennsylvania. And I just want to do a quick presentation for the members of MAEA and talk about the SBA, Small Business Administration loan programs. There's two that I'd like to talk to about today. And those programs are basically out there to give borrowers the money that they need to either start a business, grow a business, or expand their business. The first thing I'd like to talk about in the SBA loan programs is kind of an overall outline is for the most part, these are for-profit businesses. So on the nonprofit side, it's something that on a financing basis is that we don't always or we cannot finance on the nonprofit side. So it's all about for-profit businesses. Secondly, we're looking at many different loan proceeds, how you could spend that money in your business, and that would be depending on the program, and more so depending on your needs. So what I would like to do, and I'll say this at the end as well, is please reach out if you have questions based on this short presentation. Give MAEA a call and we can talk more about what you're looking for. First program that I'd like to talk about is the SBA 504, and it's a numbered program. It's specifically for fixed assets. It's for buying commercial owner-occupied property where your operating company would occupy the space in your building. And that loan program has two real benefits. It has a reduced equity injection, basically less money out of your pocket to buy that property, and it has a long-term fixed interest rate. So just to give you a little idea about the program itself, it's a loan program that it does involve your bank, bank that you work with today or a bank that you're looking to work with in the future. They would do a first lien position on that commercial property. We would represent the SBA, do a second lien position, and the typical structure is the bank does a 50% first lien. You as the borrower would have a second lien position for 40%, and the benefit behind that on the SBA side is the 20-year fixed interest rate. You know for the life of the loan what your interest rate is going to be. As we go into some changing interest rate environment, whether it be going up or staying steady, you at least know where that rate would be at all times in this program. The 10% part is the key, is in a lot of times you're being asked to put in 20 or 25% of your money into a project to buy that commercial property. This program would allow for as little as 10% equity, and with that in mind, you're keeping more on your balance sheet or in your pocket so that you can use that to grow your business, expand. Perhaps you need to hire someone once you buy a new building. Hire someone because your capacity might be increasing. So there are really good opportunities there. That would be a 20-year loan program. The 504 is also available in a 10-year loan program. And that 10-year loan program is specifically for manufacturing, for machinery and equipment that you would buy. It would have to have a useful life that's at least that long. So it would be 10-year, think more durable equipment. And when you buy that, again, same process there and same structure. 50% first from a bank, 40% by the SBA. It would be a 10-year fixed interest rate and as little as 10% down. So again, that's a program, it's very focused and fixed on fixed assets when you're buying something and you're owning them long term. Let's talk second about the SBA 7A loan program. It's the other alternative that's out there. And that loan program really is for anything, any use of proceeds that you can use in your business. So you could buy that same occupied property that you'd be buying for your business, but you can also pay for inventory, working capital, equipment. You can finance the change of an ownership if you're looking to buy another building. It can go so far where it's not a fixed asset if you're merely leasing your property and you want to make leasehold improvements, and that's someone who's going maybe into a retail type space as an example, where you could finance the leasehold improvements, get working capital, and get some inventory, and that could be that loan program. So as you can hear in the 7A loan program, a lot of flexibility that you can use all different proceeds of money, combine that into one loan. That's one of the true benefits. One loan for many different use of funds. Spend all of that money, have one amortization period. You know at the end of the life of the loan, there's not going to be a balloon. You'll be having your full loan paid off in that time frame. That 7A loan, examples that we've seen in the change of ownership. You're going in and basically you're going to pay for, say, a customer list, the equipment that's on property. Manufacturer is a great example. The manufacturing equipment that's on the property, you may be buying the building, you're buying the business, so you have either the customer list, perhaps some trademark involvement, where you don't have, we say, a tangible asset, something that you can actually touch or lean against. You would have the customer list, and that can be all combined in. Again, always a decision by the bank partner that you're working with, the company or the lender that you're working with, but you would get looked at as a one total loan. You're not breaking things out. The 7A is really flexible from a standpoint of how you spend that money, what you're looking, and the requests that you have there. So just again, to take a few minutes, the 504 loan program may be a great example as a manufacturer today that's very cramped on space. They've not moved, they lease a property today. They have the opportunity to buy a building tomorrow in the future. they're very tight on space. They're not effective as far as their process goes. Receiving is at one end and it's the improper end. Shipping is at another end and it's the improper end. This new building is really going to line things. So as you can kind of hear, they're going to immediately get some efficiencies involved. So when they buy this new building, they're going to have the ability to make more product automatically. 504 is a great process and project there, because what happens is if you're only putting 10% down, that money, let's just say for example a $2 million building, that's the difference between putting $200,000 toward that property or $400,000. And that works the same way if we say $1 million. Difference between putting $100,000 in or $200,000. You get to keep that excess capital, keep it on your balance sheet, keep it as working capital, and now that you have the ability to expand and make more product, you can now put more dollars into marketing, you can put more money into employees, you can put more money into training. So again, all these opportunities, keeping money in your business, that's a 504 great example. Let's just take one more example for the 7A. That 7A loan, you're coming in and basically saying, okay, I'm going to buy the business. I need really the money for the inventory. I'm going to buy the inventory that's there. I'm going to increase and grow the inventory. I need money for working capital because I know once I take over this business, I'm going to need that money, that adequate there, that as I grow the business and take it over, I need working capital. I'm buying the equipment that's there through the property, and I'm buying the property itself. That's all combined into one loan in the 7A. Obviously, there's some specifics behind this. There's eligibility requirements. What we try to do is have a direct communication with you. Is that if you have questions on this, let's get to the bottom. What are you looking to do? What's the project you're looking to do? And what monies would you need? What questions you have? So that, again, just an introduction in this video here today. But please give MAEA a call. We can get something scheduled and talk more about this, the questions that you have. Thank you.